Hi traders, I want to show you and explain what exponential growth strategy is. Um, the trading system is based on trading fade moves. So I'm fading bigger time frame corrections. Um, this is the strategy I use for intraday trading. I have longer term strategies that take that I have trades that last 1, 2, 3 months. Um, and during my development phase, I figured out that I needed a smaller trades so that I don't need to wait 4 months to make a profit. I'd make smaller trades inside that bigger trade. So this is usually an intraday type of trade, or at least intra-week, because trades may last a couple of days. And I want to explain you why I call it exponential growth. I call it that because my risk management I call it that because my risk management is based on the Kelly Criterion. I'm not going to explain what the Kelly Criterion is. This is not a lesson. It's an explanation of the system, but it's something that you guys should look at. Um, so imagine you're trading and you have some position sizing. Um, the bigger your position sizing is, the bigger the risk. So let's say that you you do position sizing that's always the same. Let's say if your position sizing is always the same percentage of your account, your expected growth is this one. And that's not what I'm looking for, and probably not what you're looking for. So sorry about the coughing. So we would look more to have a thing like this. That's what everybody's looking for. How do we get there? Let's call this red line the risk. So you know, the bigger your position sizing is, the bigger your risk will be. And let's call our blue line our the criterion that's going to define our position sizing. And this would be the Kelly criterion. That it's going to give you something like this. What the Kelly criterion tells you with a mathematical formula is that there's a perfect, an ideal risk for your an ideal position sizing for your system. And this would be it, where you had the biggest growth and you had this amount of risk. It also means that if you would increase your position sizing, your growth would probably be less and your risk would be much more. You'd have this risk, more of this risk. So what I use is actually the half Kelly, which is this area here. Well, this is by hand, so it should be a little more here. So this means that instead of the full Kelly would be, imagine, would give you, imagine, 3%. Let's imagine. It gives you a percentage of your account. I'd use the half Kelly, would be less, about 25% of this, to something, let's say 2.5%. And the interesting thing is that you're risking less, and of course you're looking for a lower reward, but you're risking this less and looking for this less reward. But the good thing about the Kelly Criterion is that your risk is this much less. So the thing is that for, let's say here, with this, reducing this amount of expectancy of gains, I can reduce this much expectancy of risk. So the exponential growth is my formula based on the Kelly Criterion of using half Kelly as a percentage of the trade of my account that I'm risking, that's always changing. Instead of the 1% or 2% a trade, this percentage is always changing in a way so that our growth, our risk stays like this. Let's put it in red, or let's change the color, let's put green. So this means that my risk on my trades will be like this. Remember that area, and our profit, because this is a value that will be constantly changing, our returns will kind of be like this. So keeping the same risk, not in value according to the percentage of the trade, we can expect a bigger and bigger rewards, and that's why I call this the exponential growth, is because trades are quick inside of a week, and the risk is always changing in a way that we can get an exponential growth. What happens if we have several losses in a row? Let's change this for, let's say, orange. If we have several losses in a row, let's imagine we have this, we have drawdown, would be typical. Well, during this phase, this percentage will reduce. So imagine we were trading, our half Kelly was 2%. Imagine this. So we were trading 2% here, 2.1, 2.2, 2.3, 2.4. Then we had a loss. And here our formula would take us back to around 2.3. So if we had 2.3 here, we had 2.4 on this trade, we lost there, we lost a couple of trades there, so our risk would go back to 2.3%, and then would keep going, and then we're not going to have this beautiful line here. We're going to have this. So every time we have significant losses, this percentage of the half Kelly will be affected. So that's it. Hope this fits your trading rules. Bye.